What happens when a bank doesn't have enough money? Like if you and I and the guy next door and the milkman, we all go to the bank and try to withdraw our money at the exact same time and the bank doesn't have it. What happens? That's what the FDIC is for. At least usually. The FDIC is the Federal Deposit Insurance Corporation. The government created the FDIC after the Great Depression so that if there was ever a run on the bank, your accounts were insured up to $250,000 per account. The FDIC is supposed to be self-funding though, which means banks pay an insurance premium in order to cover any gaps above or beyond what they're missing. Last year though, we had 3 of the largest bank failures ever in American history. Silicon Valley Bank, Signature Bank, and First Republic Bank. And a lot of those accounts had way more than $250,000 in them. Like, add a few more zeros. Once all the dust was settled after those 3 bank failures last year, it turned out that the FDIC was short by about $70 billion in order to insure everyone's accounts. Self-funding evidently wasn't enough funding, so the government cut a check for the difference. A $70 billion check. And that's just one of the ways that inflation gets completely out of control. Cutting a $70 billion check for something that's supposed to be self-funding, but isn't, which means that you and I and the neighbor and the milkman end up ultimately paying for it through our increased interest rates on our mortgages today.